In this session, we are going to learn how listed firms raise money through rights offerings and its implications for investors like you and me. But before we get into understanding what a rights offering is, let us first very briefly talk about the ways firms can make use of to raise money in general. Let us first talk about how an unlisted firm typically raises money. An unlisted firm, as the name implies, does not have its shares listed on a stock exchange. An unlisted firm can raise money by issuing new shares to the public at large. This process is known as the initial public offering, or an IPO for short. This process enables the shares of the firm to get listed or traded on a stock exchange. Thus, an unlisted firm becomes a listed firm through an IPO. Also, IPO, as the name indicates, is the initial public offering. Initial means that it is the first offering, and public offering means that the stock is issued to the public at large. Having said that, an IPO does not necessarily involve raising money by issuing new shares. In an IPO, existing shareholders can also sell their shares fully or partially to the public at large. This is what we call as an offer for sale, or OFS in short. For example, the Life Insurance Corporation's IPO in 2022, which has been India's largest IPO to date, did not involve issuing new shares. Rather, it only involved selling existing shares by the Government of India, which was an existing shareholder in LIC at the time of the IPO. Thus, an IPO, as you can see in the figure, can not only involve raising money by issuing new shares, but it can also involve selling existing shares by current shareholders of the firm. Now, once a firm becomes a listed firm, it can raise additional money by issuing new shares to investors. Such an offering is known as a seasoned equity offering, or SEO in short. Now, SEOs can take three different forms. Number one, follow-on or further public offerings, or FPOs in short. Number two, rights offerings. And finally, number three, private placements. While each of these three methods involve an issue of shares to investors, they essentially differ in terms of whom the shares are intended to be issued to. In an FPO, shares are intended to be issued to outside investors. However, existing shareholders are also free to participate in an FPO. Recently, that is in April 2024, Vodafone Idea raised close to 18,000 crore rupees through an FPO. This has been the largest FPO to date in India. Now let us talk about a rights offering. In a rights offering, shares are intended to be issued to the existing shareholders of a firm. However, outside investors can also get a chance to participate in a rights offering under some conditions. Finally, in a private placement, shares are typically issued to a small group of investors. These investors could be insiders, for example, promoters, or they could be outside investors as well, such as private equity players, banks, financial institutions, etc. Having said that, both an FPO and a private placement can potentially involve the share of existing shares as well. The sale of existing shares, as we already know by now, is called an offer for sale, or OFS in short. We are specifically going to focus on rights offerings in this session. At this point in time, a number of questions might pop up in your mind. What exactly is a rights offering? What are the different choices before an existing shareholder of a rights issuing firm? What should you as an existing shareholder do when a firm announces a rights offering? Okay, now let us try to address each of these questions one by one. First of all, let us understand the meaning of a rights offering. A rights offering is essentially an option that allows but does not obligate the existing shareholders of a firm to purchase its shares, typically at a discount to its market price. Suppose there is a firm whose shares are, let us say, currently trading at a market price of rupees 100 in the stock market. Let us further assume that the firm plans to go for a rights offering with one right for every share, and that 5 rights can be used to buy one share at a subscription price of, say, rupees 70. So if you own 5 shares in this firm, you will get 5 rights. So this implies that you can use these 5 rights plus rupees 70 to buy one new share of this firm, which is otherwise priced at rupees 100 in the market. So therefore, rights are valuable options that allow the existing shareholders of a firm to purchase its shares at a discount. Now let us discuss different choices before an existing shareholder of a rights issuing firm. As an existing shareholder of a rights issuing firm, you can do one of the following. First, you can participate in the rights offering by exercising your right. Second, you can renounce your rights in favor of someone else for a price. And finally, the last choice before you is to do nothing, which means you let your rights to lapse. Now, if you neither exercise your rights to buy new shares nor sell off your rights, you are essentially leaving money on the table. This money gets transferred from non-participating shareholders like you to participating ones. So therefore, when a firm comes up with a rights offering, it generally makes sense for you to either use your rights to buy new shares at a discount or sell off your rights in the market. Of course, you can also sell your existing shares before these shares begin to trade without rights. However, if you do nothing, you may stand to lose. However, please note that this wisdom holds for most but not all rights offerings. So there could be several other factors at play as well. So this marks the end of our short session. I hope you are now more knowledgeable about different ways a firm employs to raise money and what you as an existing shareholder should do when a firm comes up with a rights offering. Thank you.